Hi everyone, welcome back to our video series titled Investment 201 with Dr. Peng. In our first episode, we talked about tariffs and deglobalization. And in our second episode, we talked about investing in China. In our third episode, we talked about the investment formula. And today, we're going to be talking about bond ETFs and bond funds. So join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi, Dr. Peng, great to have you back again.
Hey Isaac, it's great to be back here.
Right. So to all our listeners, last year we actually did an episode about bonds, but that is a bit more basic, right?
Yes.
We talked about what bonds are, where the returns come from, etc.
Right.
So if you are interested in the episode, the link is in the description below. In today's episode, we'll be diving deeper into bonds, and it's going to be a little bit more technical as compared to that episode. And really, let's just dive right into it, right?
Sure.
So retail investors are quite familiar with stocks, right? And but when it comes to bonds, it's something that my sensing is that a lot of people are not really
familiar.
Less familiar with bonds, especially when it comes to bond funds and bond ETFs. So I think it's very good that we have this episode where we dive deeper into bond funds and ETFs, right? So maybe Dr. Peng, you can briefly explain, what's the difference between, a bond fund and and bonds in general.
So bonds is basically issued by different institutions. In a sense, essentially they're borrowing money from investors, whether it's government bonds or corporate bonds, and so on and so forth. So if it's a government bond, then the government is borrowing money, from investors to do what they have to do. Corporate would borrow money, and sometimes these bonds are secured with collaterals. So sometimes there's mortgage-backed bonds, which is backed up by people's mortgage payments. Some are asset-backed bonds, and so on and so forth. So essentially, bonds, we talk about it. At the end of the day, is basically people are borrowing. And if you look at instruments or bond indexes or bond ETFs made against these bond indexes, it's the most popular way, again, to build a bond index is to use what we call market cap again. Very similar to stock market cap. Now, people may think that there's a lot of stocks. Actually, there are many more bonds than stocks. One of the reasons is because, let's say, if you're a stock, you represent a company, and typically there is one type of stock, a common share. For example, DBS would have, one stock, and anybody buy and sell on the stock exchange would be buying and selling the same share of DBS stocks. But in terms of bonds, there could be many different forms of bonds. And the main difference, even if it's a DBS bond, it could be issued a 5-year bond, a 1-year bond, different maturity levels. And these different maturity levels associated with different level of interest rate payment because they're borrowing for different periods. So there's actually more bonds than outstanding, different type of bonds than stocks.
Right. So Dr. Peng, could you briefly explain the difference between investing in an individual bond as compared to investing in a bond fund or bond ETF?
Right. So there's a pretty big difference. So if you're investing in an individual bond, you're basically lending your money to one particular entity or one particular institution. So for example, if I'm buying a Singapore government issued bond, I'm basically lending my money to Singapore government, right? One institution. If I'm buying a DBS bond, I'm lending my money to DBS. If I'm buying ABC company bond, I'm lending it to that ABC institution. Now, if I'm buying a funds or a unit trust or an ETF, then I'm investing in a fund that invests into these different bonds, form a portfolio. And as we talked about in last year's episode in bonds, there are many different forms of bond. And so typically, a bond fund would invest in, tens or 20s or sometimes even hundreds of different bonds. And this help mitigate the risk through diversification. Now, very recently, probably people would remember there has been quite a bit of default in the Chinese real estate sector. The bonds, from these Chinese real estate developers, whether it's Evergrande or some of the other developers that people probably have remembered. And so if you had put all your money, for example, invested with Evergrande, you would be lost significant amount, if not all. But if you invested in a number of these bonds across different issuing institutions, across different sectors, across different countries, even though there are some bonds defaulted, your overall portfolio likely will still be okay.
Right, so the main advantage that bond funds have is, of course, diversification, right? So to the example of, if let's say a few bonds default, if you have a bond funds of hundreds of bonds, it's probably, you might not even notice.
That's right, that's right.
But if, let's say, if you buy just a bond of a single company, single, entity, if that collapses, the whole amount is gone.
That's right.
But of course, there is a counter argument, which is that, if you buy an individual bond, right, you're essentially lending money to, let's say, a very established institution, DBS, for example, right? And the likelihood of DBS collapse, of course, is small. And you know that after 5 years, you are going to get your capital back, and during that 5 years, you will earn that interest. That's something that is very appealing to investors, right?
Yeah, it's very simple,
straightforward.
You can see it.
Yeah, we can see that the money come back. And one of the main arguments against the bond index bond fund, for example, is that depending on interest rates, depends on the sensitivity of the bonds in that fund to interest rate. There is a chance that I might not get my capital back after 5 years. So could you explain why this may be so, and and how should we think about this?
Yeah, I think it's essentially the difference between a individual bond and a bond fund is that you can consider in an individual bond you're buying one bond. In a bond fund, you're buying hundreds, or at least 50 or 30, these. And so that's the key difference. The reason sometimes people think an individual bond fund you don't lose money is because when you buy that bond, some of the accounting methods, depends on the platform, they use cost-based accounting. So essentially, how much you pay, that is the cost, and that's how the value is determined. They don't mark to market. But in the bond fund, because you're regulated by MAS, and because you have to accommodate people coming in and going out of the fund, you have to treat everybody very, very fair. You have to mark to market. And that's what happened, that the NAV would reflect, the interest rate movements and so forth. So, but it doesn't mean if you buy one fund, there's no movement. It's just you don't see it because they use cost-based accounting as opposed to market-based accounting. So that's the first thing. The second thing we talked about, diversification and default risk mitigation. That's diversification essentially. The third thing, the key difference is really the cost. So if you buy one single bond fund, and particularly as a retail or individual investor, the amount is small when we buy, right? So when we buy and the bid-ask spread, we have to suffer that. Versus if you have a large portfolio, the cost typically is much lower because you have volume, you have volume, in there. So the cost is typically lower. So essentially, you're getting a more diversified portfolio at a more reasonable cost. Plus, there's a lot of these bonds are requires more professional management, professional judgment. So, for example, I give you a case. What if in the very, very, very unlikely scenario, let's say DBS get downgraded to junk bond because they didn't manage their portfolio well? What are you going to do as an individual investor? Are you going to continue to hold it even though the default risk become much higher? So it put a lot of burden on you as an inexperienced, not professional to make these judgments, where if you have a fund manager, they're constantly looking at this, making adjustments, making sure the portfolio is managed well against the objective or the index and so forth. So to me, there is really not a great reason for any individual investors to buy an individual bond versus buying a diversified portfolio of bonds at a lower cost with professional management. And as I explained, the illusion, the illustration where the individual bond doesn't lose money is simply based on a cost-based accounting versus market-based. Mm-hmm. And it's not really they're not losing money, they're just not marked to market.
Right. So it's a bit of mental accounting, is that, of course, if DBS don't collapse, just an example, just for illustration, right? And of course, we're just thinking, okay, I'll get my capital back in 5 years. But actually, like you mentioned, along the way, if you want to sell the bond, you might have to take a lower price, because if you try to match it with what it's going for in the secondary market,
that's correct.
You might have to take the loss. So actually, there is a lot of volatility that might not be
put it
so apparent,
properly accounted for. Yeah.
Right. And also onto my question about some bond funds, especially after 2022, we see that they even after 3-4 years or even 5 years, they are not back to break even, right?
Yeah.
So how should we think of that? Is that an issue of whether it's an individual bond in a bond funds, or is it simply just interest rate sensitivity and duration?
What you mentioned in 2022 is mostly interest rate sensitivity. Now could be someone bought one particular bond, or buy one particular bond fund did certain things, may have contributed. But if you look at the entire bond market, what happened is that if people would remember, during COVID, government lowered the interest rate across the globe to very, very low levels. But because of supply chain disruption, high energy costs and all of these things, inflation came up. And so the central banks has to rapidly raise interest rate to combat inflation, because we don't want inflation. And that has resulted losses on pretty much all the bonds, whether it's government bonds or corporate bonds, whether it's Singapore government bond or US government bonds, and so on and so forth across the board. The only market didn't quite get impacted is Chinese bond market, because China is run on a very different economic cycle. So that's what happened when the central bank or U.S. Federal Reserve or MAS raised interest rate. The bond price, when you mark the market, suffer and got losses. Now the fortunate event is that when interest rate higher, the bond price went down, but future returns are also higher. So there's this dynamic. Yes, if you had bought some bond instrument, your price went down, your return negative. But going forward, you would gain more returns on your bond portfolio than 2020 or 2021 levels.
Right, and that's why it's something that our investment team look into very closely when it comes to the average duration of the bond funds. that our
Yes.
clients implement. And
Yes.
it really depends on their goals, right, and their time horizon.
Correct.
So if
correct.
it's like a short-term goal, a lower risk portfolio, the bond funds that we use would have shorter duration, which is
less
lower
risky.
interest rate sensitivity.
That's right. So that's a very good point. So for different investors, you got to be very careful in terms of these different bonds. When interest rate increases, the longer the duration or the longer you borrow money to these institutions, the more sensitive the price are. And so, but if you have a longer investment horizon, you can probably endure some of these sensitivity and recover over time. But if you have a short horizon and then you invest in a long bond instrument, your losses may be locked in because you reached your end of investment horizon. So what you said is absolutely true. And one of the key things we manage, and as well as many other investors, such as insurance company, pension funds, and so on and so forth, is manage what we call duration. It's basically how long you will be needing this money, and to not to get to extra, duration level portfolios that expose you to more interest rate sensitivity than necessary.
Right. So I get the argument, like, okay, especially when it comes to risk, right? If you buy an individual bond, definitely it's higher risk. But there's some people that do build what they call a bond ladder.
Yeah.
Right. So instead of, okay, let's say our listeners and our viewers are convinced that, okay, we should diversify our bonds, but why don't I do it by myself?
Yeah.
Based on when I need, based on my liability, I can construct a bond portfolio. I can diversify instead of buying a bond fund.
Yeah.
Right. So, what's your thoughts on this?
Well, I think you can do pretty much what you do with a bond fund, and probably lower cost and more diversified, and with professional management. Like I said, these are the benefit, because even if you're an investor, I can buy bond laddering, and let's suppose I have $1 million. I mean, it seems a lot, but once I divide it into these different tranches, it became a very small amount. And in the bond market, the average ticket trade size is typically $1 million or above. So, one trade. So you have this little, amount compared to the average ticket size. What are you going to do, right? And it will create a lot of difficulties. Let's say everybody, is buying and selling at $1 million level, and you have, let's say, I have $100,000 portfolio. I mean, not a lot of people want to trade with you, because you end up with odd lots that they don't know how to deal with. So unless you have a large portfolio, one, you can diversify properly. Two, you're not subject to this increased cost because you're trading a smaller amount. And then three, like I said, these bond market, you mentioned interest rate increases are lower. There's a lot of changes, right? Particularly corporate bonds get downgraded. Even government bonds get downgraded. U.S. was just downgraded by Moody's not too far ago. How do you deal with this, right? Does this, touch your risk tolerance? All of these things, and then more, as you buy it, and then at the point you have to unwind it, you have to sell it. So all of these requires professional management. And to me, I couldn't find one good reason to buy individual funds or buy bond laddering, unless you have a lot of money and you can then properly diversify, and you have to have some knowledge, professional knowledge, because all of these bonds are traded on the counter. It's not traded on the exchange. People probably don't know this. So when you are buying and selling a fund, you have to find someone trade with you, like a counterpart, versus, if I buy and sell a stock, the exchange acting as a counterpart. as the intermediary. So, and there's a lot of liquidity. On the bond, you have to call people and say, hey, ASIC, do you want to buy my bond? Oh, no. Okay, what about Chris? Oh, no. Taishen. So, and then you have to get price. Okay, how much are you willing to pay, Chris? How much are you willing to pay, Exit? And so you may not want to do it yourself. Then you use a broker. The price are typically higher, or the cost you incurred is typically higher than a professional bond portfolio manager. And so to me, there's really not a good solid reason to use individual bonds versus a bond fund.
That's a fair point you raised, especially when it comes to the size of each bond purchase. I think the face amount typically is about 200 or 250,000. So even with 1 million, you only can buy 4 bonds, 5 bonds. And it's not really very diversified.
Yeah,
on top of the challenges of trading it in the secondary market, right, where it's not as easy to trade as compared to individual stocks.
And not to mention that, when you are buying and selling individual bonds, you have to make sure the other side don't have better information, meaning that the bond is going to be downgraded or the company is not doing well. And you as an individual investor, you don't know. So, like Evergrande was trading pretty well up until a few weeks before they collapsed, right? Some people may know already, and they may offload Evergrande because they have an information edge, right? They're professionals. And so I would not, like I said, all of these reasons, I would not try to, even institutions as safe as DBS, they could run into trouble. There could be cybersecurity issues, or they could have a bad quarter of earnings that will impact their price. And all of these things, as an individual, there's no way you can deal with it.
Yeah, definitely. So, but of course, if, like you mentioned, if you have the time, interest, expertise, the capital,
go have fun.
Those are. But this wouldn't apply to most investors.
No,
I would say.
I would consider myself a professional after being in the business 30 years, run money myself. I wouldn't even do it myself.
Right. Okay, so let's move on to the yield curve.
Yes.
Right. So a lot of people were concerned when the yield curve was inverted.
Yes.
Right. So maybe you can briefly explain to our listeners what an inverted yield curve is and whether we should be concerned about it.
Yeah. So the inverted yield curve is basically saying that at the shorter end, which is the shorter end typically less than 1 to 2 year, the interest rate are higher on the bonds than longer end. Now it could be coming from a few different things. As we know, the bond yield curve is really two or three components. One is the inflation. So one thing it could mean short-term inflation are higher, but long-term we expect inflation to be much lower, right? So that's okay. The other thing it could mean is that, hey, short-term I can make a lot of money, therefore I'm borrowing money at a higher rate because I can make money. But long-term I'm not too optimistic. Therefore I'm not going to borrow at this, similar rate. So I'm only willing to borrow at a lower rate because I think it's not going to be as good as short-term. Now, most people don't like this scenario, right? Because typically people expect over time, economy to do well and all of these things. So the inverted yield curve sometimes could signal long-term prospect is not as good. And that could, mean, not so good things for the bond market, for stock market, all of these things. So people sometimes get a bit nervous on the inverted yield curve. But like I said, there's many other reasons like inflation and so on and so forth that made the curve inverted. But the inverted yield curve, in terms of how we deal with it, is that it basically means in the short term, it could, if we analyze it, sometimes it means that it produces higher returns. So it means that from a investment perspective, maybe it's better off to, shorten the duration of your portfolio to take advantage of a higher return than extending it. So that's kind of the implication.
Right. So a lot of people cite the inverted yield curve as a signal for an upcoming recession. I think the stat is like typically after 18 months of the yield curve being inverted, a recession tends to come. Is this something that you believe in as well, or do you feel that it's just a coincidence?
There's certainly some rationale to it, and as I mentioned, economics is a cycle, and particularly with the way that global central banks are managing their interest rate, basically they're trying to use monetary policy, which is interest rate, to a large degree, and fiscal policy, try to mitigate the up and downs of the economic cycle. And so you can think of, from a monetary perspective, when the economy are too hot, then the central bank would raise interest rate, try to reduce the money going into the system, slow down the economy because it's too hot, right? And vice versa, when the economy is not doing so well, the central bank lower interest rate, encourage people to borrow, to put more money into the economic system, generate more economic activity. So in that sense, when you have an inverted yield curve where the short-term interest rates are high, it basically means the central banks has raised the interest rate and to cool down the economy. But what's going to happen many times is that the central bank overdo it because they don't want it to be too hot, inflation. So when they overdo it, the economy slows down too much, and instead of cooling down, it went through recession. So that's possible. So that's the rationale when you think about the dynamics. When short terms are high, people borrow less, less money going into the system, less economic activity, and the economy slow down. Now, sometimes it's a soft landing, which means it doesn't go into recession. Sometimes it goes to recession. Sometimes it goes to a hard landing, which is more severe downturn. So these are reasons, I think, but it doesn't necessarily always follow. But certainly something that people would look into. What's the rationale and so forth.
So how does that apply or affect me as a bond ETF, index bond ETF or index bond fund investor? How should I view the inverted yield curve, and what does it mean for me, essentially?
So in the inverted yield curve, from a pure investor's perspective, if you're investing into these bonds, it basically, the interesting thing about bond instrument is that the market price literally tells you what the expected returns are going to be, because that's why it's called fixed income, right? So you can calculate any point along the yield curve. If I hold X number of days or next number of months, what's my expected return from that yield curve? And when it's inverted, it just means that the short end is providing higher return. Like I mentioned a little bit earlier, that and because it's on the shorter end, it's less sensitive, less duration risk. So you create a scenario maybe for certain investors that has less duration needs. Maybe it's better off to invest in the shorter end of the yield curve. And you often see when in an inverted situation, people may shorten their duration of the portfolio and try to capture those higher yields in the short end of the yield curve.
Right. So as a bond index fund investor, there is higher, at least for now, it seems to be uninverting, but at least for now, if I take less duration risk, I can get a higher yield. But this is what I would say at normal times. Is not normal because
Yeah, normal
typically-
times, people would expect a yield curve that goes up because, as the duration goes up, and duration is basically measuring how long I'm lending my money. So the longer I lend the money, then the more interest
I should get.
I should
Yeah.
expect. And so that's why normally it's a positive sloping yield curve. And so when it's inverted, it means that the short end, most people would interpret the short end are pretty attractive. Therefore, people, a bond fund may lower their duration exposure of the portfolio to capture those returns.
Right. So if I'm in let me just go slow because it's quite complex.
Yep.
Right? So if let's say I'm invested in a short duration bond fund, I get a higher yield for now.
Yeah.
But of course, if let's say the short term interest rates fall, the bond, the higher yield bonds that I have in my bond fund would mature.
Yep.
Right, over time, and you'll be replaced by a new bond that potentially has lower
That's
yield.
correct. That's correct.
And that means that moving forward, my yield would be lower. So that's why it means for me when for an inverted yield curve now, and the effect of it, if let's say it uninverts with the short end falling.
Then
Did I get it right?
Then you gain some extra returns.
Yeah. Right. Okay.
That's right. Yeah.
Got it. So so essentially, it's something to take note of. I think when it comes to investing in a bond fund,
Exactly.
you're not. I think you're not locking in the higher yield for the next few years, right?
And
Because
this is one of the other advantage. Going back to our discussion on individual bonds versus bond fund, when these opportunity arises. A professional bond manager may be able to take advantage of these things versus the individual, hardly, to just talk about it, take a bit of thinking, right, to manage that and make sure you manage it right every day. Yeah.
Right. So you mentioned about investment, professional investment management, right? And a lot of times they don't just look at the duration.
Yes.
Right? They also look at the credit quality of the bonds.
Yes.
Right. So maybe you can just explain what is credit. How does it relate to a bond? How does this relate to a bond investor?
Yeah.
And maybe touch a bit on what does credit spread mean?
Yeah. So the credit is basically capture the dimension that as a bond investor, you're lending money to the institution. And the credit basically tells you how good is the institution in terms of returning the money back. And it basically the financial soundness, of this institution. And that's the credit. The lower the financial soundness, the more return you should get because you're expose yourself to more credit risk. The higher the financial soundness, then you should receive less return because there's less credit risk. So as an investor, credit is very important because I've seen many investors go chase higher returns and not realizing they are exposing themselves to a much larger credit risk exposure. Because sometimes, this is very critical, sometimes, we just talk about, there's this credit rating agency downgrading a bond, downgrading their credit quality or financial soundness. But on average, these ratings has a 6 to 12 months lag. So essentially their financial soundness has already deteriorated, but these rating agency, because they need to analyze, they need the information to come out, and by the time they downgrade, it's already deteriorated 6 to 9 months.
Right. So before they are downgraded, it's already terrible. It's
really happening. And so, as a non-professional investor, it's very difficult for you to analyze all of these things in real time, and credit risk is very important. We just mentioned, Evergrande not able to pay. So so normally, again, I would not suggest people, if you want to buy individual bonds and you want to do your bond laddering, despite all the disadvantages we talk about, you still want to do it. Okay, buy, Singapore government or U.S. Treasury or some of these, much stronger financial institutions than by individual companies, because that's a lot of risk.
Right, and refrain from chasing yields, right?
Refrain, because
maybe a government bond is giving 3 or 3.5%, but you see a company that's giving 5, 6, 7%.
There's a
interest.
reason.
Yeah,
there's a reason. Yeah, there's a reason. Just like, if I go borrow money and if I don't have a very good credit quality or financial soundness, I have to offer more interest to the people lend my money.
Right. Okay. So I think in summary, right, of course, for most investors, it makes sense to invest in a bond fund, whether it's index or professionally managed, as compared to buying your own individual bonds.
That's right.
Right. Because of the complexity of implementing it and also having to manage it.
The cost, the potential risk.
Yeah. And of course, to be mindful that if you buy an individual bond, if you insist on buying an individual bond to create your own bond ladder, that's also fine. Like if you have the capital, the expertise, and the time, but to be mindful of to refrain from chasing after yields, especially if you're buying from non-government entities, right?
That's right.
Because there is always that default risk. Yes. And with each individual bonds, the position is quite big.
Yeah. And the last thing I would say, when we say default risk, it doesn't mean the company default like Evergrande. It could just be lowered, their credit quality will significantly impact your price.
Right.
Yeah. It doesn't have to go into default.
Right.
Yeah.
Okay. Yeah. So thank you so much again, Dr. Peng, for your time. And as to our listeners, you can see how complicated things like bonds, investing in bonds can be. But I think you can rest assured, especially for our clients, is that it's something that our investment team takes very seriously. We consider a lot of factors that may not be so apparent, but it's something that it's very important for us, especially with the duty of care that we have, to making sure that our clients achieve their non-negotiable life goals, ikigai goals, in a comfortable and reliable manner.
Yes.
Right? To all our listeners, I hope you enjoyed today's episode, and do remember to subscribe if you haven't done so already. As always, thank you for listening, and I'll see you all in the next episode.
Thank you.
All analysis, views or opinions from interviews, recommendations and other information broadcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.